Look at this interest calculator. If you just let it sit in the S&P 500 for 20 years and didn't touch it or even add to it, it would be nearly worth $7 million. The sooner you start investing, the more time compounding interest has to exponentially grow your account. Hi, my name is Josh, and I'm going to help you start investing today. Growing up, I was very skeptical of the stock market, and I thought that you needed to have a financial background or just be lucky to be successful, and apparently that's not the case. Literally anyone can be successful investing in the stock market. Investing may sound complicated or seem risky or intimidating, but it's actually really easy once you understand it. So first off, why should people even invest? Well, for one, it's to make our money work for us. Investing is a passive way to make money, both through stocks going up in price and through receiving dividends that companies pay. Number two, saving money is losing you money. Here's a hypothetical example. Let's say that you have $1 million in a bank. Most savings accounts only pay out 0.01 to 0.03% interest rates. 1 year later, that 0.03% makes you $300. If you were to invest that same $1 million in the S&P 500, which historically has a 10% return, you would make $100,000 at the end of that same year. This is a huge difference, especially when you factor in number 3, which is inflation. Investing can fight inflation. If inflation is 7%, you lose 7% of your buying power that year. If you keep your money in a savings account with a 0.03% interest, your money is worth 6.97% less at the end of the year. Compare that to investing and getting 10% interest. With 7% inflation, your buying power would have still increased by 3% that year. And then we have number 4, which is my favorite, and that's compound interest. This is the interest on an initial deposit and on the accumulated interest from previous periods. Here's an example of why this is so powerful and can turn anyone into a millionaire. Let's take that same $1 million. Every year, your money makes even more off of interest. Look at this interest calculator. If you just let it sit in the S&P 500 for 20 years and didn't touch it or even add to it, it would be nearly worth $7 million. The sooner you start investing, the more time compounding interest has to exponentially grow your account. So now we know why we should invest, but what do we invest in? When most people talk about investing in stocks, they're buying shares of individual companies, like Apple or Tesla. There's actually a lot of work that goes into successfully picking the right companies, and you'll have to actively manage them over time. This includes reading earnings statements, paying attention to company news, analyzing stock charts, and stuff like that. There is risk involved in picking individual stocks as well, because individual companies can go out of business, and that means that you'd lose your money if you were invested in them. If you stick around to the end of this video, I'll do a live demonstration on how to buy a stock and show you just how easy it is. ETFs are like a basket of stocks. The best thing that I think beginners should invest into are ETFs or index funds. They hold many different individual stocks within their funds, and they replace the worst performing ones with better ones. This eliminates a lot of the risk of going bankrupt and losing all of your money, and the fund managers do all the stock research and monitoring for you. The S&P 500 is an example of this, and it holds the top 500 companies in the United States. Every quarter, its managers reassess the lowest performing companies, and they may decide to replace them with better ones. If you look at this chart of the S&P 500, you can see that since it was created, it generally increases over time. On average, it has had a 10% return every year. That means that some years are positive, other years are negative, but if you play the long game, you're almost guaranteed to make money. And as you can see here, even though the stock has declined over the past couple years, there's been more positive years than negative ones. Here's a fun fact. If you invested $100 into the S&P 500 in 1980, today in 2023, it would be worth nearly $11,000. Index funds are very similar to ETFs in that they hold many individual companies, but they all follow a certain theme like technology, healthcare, or energy, etc. They may even index themselves to another ETF, but with like a little twist. Examples of this being an index that follows the S&P 500, but only focuses on the top performing growth stocks, dividend stocks, or value stocks within the main fund. Most financial advisors put their investors into index funds because of the lower risk, the fact that they're passively managed, and their long-term growth potential. One thing I will say about ETFs and index funds though, is that they don't normally have high price swings like individual stocks do. This means that individual stocks can have much larger gains than ETFs or index funds, but it also means that they can crash just as hard. If you're an investor who wants to passively make money, then ETFs and index funds are the way to go. If you want to actively take advantage of price swings and make lots of small gains, then go with individual stocks. This leads us to the next question. Where do I invest? There are different types of investing platforms that you can choose from, but there are 2 account types that I think people should start with. If your goal is to invest for retirement, then open a Roth IRA. A Roth IRA is a tax advantage account that allows your investments to grow tax-free, and it's also tax-free to withdraw once you turn 59.5 years old. You're allowed to withdraw the money that you've put into a Roth IRA at any time without penalty. However, you'll be charged a fee to take out any of the earnings before you turn 59.5. Because it's tax advantage, there's a $6,500 contribution limit per person every year. Once you're able to max out the annual contribution, then I'd invest into a taxable brokerage account. A taxable account is where you could buy and sell stocks on your own, and you pay taxes on the gains made from trading stocks or collecting dividends. Examples of brokerages include Robinhood, Webull, Fidelity, Vanguard, or M1 Finance. It's really easy to sign up, link your bank account, and begin investing with any of these brokerage apps. And if you look in the description below, you can use the links there to sign up for any of these brokerages that I use, and we'll both get free shares or cash to help our accounts grow. There's not much difference between online brokerages these days. The main differences come down to the user interface and whether or not they charge commission fees. So now I'll show you how to invest by using one of these apps to buy a stock. I'll be using Robinhood because of how beginner-friendly the user interface is. But before that, I just wanted to take a quick second to let you know that I wrote an in-depth book for beginners that want to learn how to be successful investors or traders. Link down below. So this is my portfolio. You can see how much I have invested and how much cash I have available to trade with. If I wanted to buy a certain stock, I'd click on this little search icon and either type in a company name or its ticker symbol. A ticker is basically just a few letters that can be used to easily find a company without spelling out its entire name. When I click on the stock, its information pops up and I can review its stats, read news articles, see analyst ratings, and stuff like that. Then to buy some shares, I'd click on this trade button and then the buy button. For those of you that haven't enabled options trading, you won't see that button, but that's more advanced anyways, and we're not covering that in this video. Once I click the buy button, I'd enter the number of shares that I want to buy and then click review. If I just wanted to spend a certain amount of money, or if I couldn't afford an entire share, I could just click the shares button and change it to buy in dollars. Then I'd enter a new dollar amount and click review. It's as easy as swiping up on the screen and the buy order will be made. Most brokerages these days allow fractional share buying, which is great because you can take your investment and evenly split it however you want. And like I said earlier, if I couldn't afford an entire share, like this one, then I can still buy a small piece of it without having to save up for an entire share. If you want to learn how not to invest or what mistakes you need to avoid, then make sure to subscribe and then watch this video next. And if you're good on those, then hit the like button and watch whatever video YouTube thinks you'll enjoy next.